Hey, it's Rob again. Thanks so much for watching all of my videos, by the way. I really appreciate it. I get lots of comments that are forwarded to me, and I've had people actually call me as well and share information and ask about some of the videos, and feel free to do that. Share this video with any of your friends by clicking on the share button down below, and also please subscribe to and like the videos as well, and you'll get all of these as they come online. I've got my readers on today because I'm sharing some information that I've pulled on all sorts of stuff regarding loans. So here this video is being created in June of 2022, and my question is why home loans today aren't what they were in the past. Well, so let's ease some concerns about this, because 15 years ago there was one heck of a housing crash, and a lot of it was caused by mortgages. And why is that the case? Well, it was ease of credit and various other things, and then of course a housing crash where people couldn't pay the mortgages back, and it just made things worse and spiraled. So something that was created a little before the crash actually last time was called the MCAI, Mortgage Credit Availability Index. And what it was a standardized index that focused on mortgage credit. Basically, the index determines how easy it is to get a mortgage. The higher the index, the more available mortgage credit becomes. Here's a graph going back to 2004, and you'll see 2004, by the way, was before the crash, if you remember. That basically started happening in 2006 and 7. And when we look at this graph, we can see standards that started at about 400 on their standard, and it doubled to over 800. 868.7 was the peak. At that point in time, so many bad loans were being done, subprime mortgages, things like that, lousy credit score mortgages, and all of a sudden the housing market stopped. People were borrowing these massive percentages on their homes, and they couldn't pay them back. So what happened was the market started crashing because a bank would come along and foreclose on a property at a lower price. It would sell, it would set the standards lower, and people kept spiraling down, and the prices all got much lower in most cases. By the way, not all recessions prices drop, and this one they definitely did. So on this graph up here, you'll see that this all started in 2004. It hit the peak at 800. It made a massive correction. It was incredibly difficult to get loans in 2012, 13, 14. And then it eased up a little bit. And you can see, if you look at this chart again, that the easing up came along and it kind of went up and down and up and down. But for the most part, loans have been relatively difficult to get ever since. So what does that mean to you? Well, for instance, what it means to you mostly is that on this graph here, if we look at the number of loans that were done with a credit score of less than 620, and 620 is not a good credit score, guys. Loans that were done with less than a credit score of 620 in billions of dollars in loan volume, and you look at 2006, 2007, and see how much it dropped off in 2008 and subsequently, and then it stayed fairly stable. Basically, in 2006, with a score of 620, received $376 billion in loans. In 2021, that number is only $80 billion, and it's only $20 billion for the first quarter of 2022. So if that stays on track, obviously that's another $80 billion. Now, these are special loans. There's not very many of them being done, so therefore, there's not much credit risk out there. A second thing to consider is that the equity in homes. Americans have more equity in homes than they have in years. During the recession, 20% of Americans had more than 50% equity in their homes, and now more than 50% of Americans have more than 50% of their homes. Quite a bit more than 50%, actually. So for those reasons, we're not really expecting prices to drop and a mortgage situation to develop as the market slows down. Thought I'd pass that along. Put any comments down below, share with a friend, subscribe to my videos. Love that you watch them. Thank you so much.